So today I want to talk to you about cap rate. What is a cap rate? A cap rate is an evaluation used in real estate when comparing an investment property with another investment property. To better understand that and figure that out, what is the formula for that, or how do you get a cap rate? The way that you do that is you take your yearly NOI, or your net operating income, and you divide that by the purchase price, and that's going to give you your cap rate. And to better explain that, I have a pro forma in front of me that I want to go through of our El Mirage project down in Arizona. Okay, so let's take a closer look on page number 3 of our pro forma, the Village on Greenway in El Mirage. As you look at the left-hand side here, that's just your basic purchase info. As far as the purchase price, the initial market value, your down payment, buying cost, etc. I don't want to talk too much about that today because we want to talk about cap rate and how to figure out how to get a cap rate. So the first part that you want to start is going to be on your top right-hand side. You want to really look at the rents. Figure out what the rents are going to be within that location by looking at other comps within that area. And that's what we've done here specifically for the stacked triplexes. So for this specific property, we have $3,900 for the gross rent. There's some additional sources of income that you can look into as well, like a pet fee, maybe a tech package. We don't have it on this one. But essentially, you want to be able to understand what your income is going to be and what you're going to be bringing in on a monthly and yearly basis. Once you figure out those things, that's going to get you what's called an operating income. You want to know what you're going to be making on your investment property, which is really important. That's what it's all about. And once you know that, then you can take it a step further. Right below that here we have what's called the expenses. And I feel like this is where a lot of investors kind of drop the ball. You really want to understand what your expenses are going to be with a FIG property or any property that you're looking into. With FIG, it's pretty straightforward because we've done this over and over again, so we have a good understanding of what those are going to be because we've seen it in other projects. But let's go into depth on that a little bit more. So the first item there is a cleaning and maintenance item, or expense, I should say. That's not actual money out of your pocket. That's just something that you want to plan on as an investor, just in case you have something that pops up that you're not anticipating. That's just more of a cushion for you if there's some sort of repair that the builder can't cover out of the 1-year warranty, or if it's not covered in the renter's deposit. The next step there, or expense I should say, is going to be your insurance. You want to plan on how much insurance is going to be. With FIG properties, it's quite a bit lower because the insurance is covered in the HOA, which we'll talk about here shortly. You also have your property management. So with FIG, Fourplex Investment Group, we had Max PM. They charge us 7% expense. If you're looking at other investments, you want to understand what or who's going to be managing that property and what they're going to be charging. Taxes. That's one thing that can vary just a little bit depending on the state and also the location within the state. One of the ways that you can figure that out is talking with the title company, talking with the county assessor to see what the taxes are assessed at, and you want to find what the tax rate is. And once you understand that, then you can factor in what the taxes are going to be. Right below that, we have what's called the association fee or the HOA fee. That's the highest expense for the FIG model that we have. But there's a lot of things that are included in that. You have water, sewer, garbage, extra insurance, extra maintenance, snow removal, landscaping, clubhouse, pool in some locations. So you're actually getting a lot for that. So it's good to understand whether it's something you're doing with FIG or something else, what's included in that HOA, and is it really worth your money for what you're paying for that. So now that we've gone through the expenses a little more in detail, you can add those together and you're going to get what's called an operating expense total. We have the operating income, we have the operating expense. As you subtract your expenses from your income, you're going to get something that's really important. You're going to hear this often when investing. It's called an NOI, or your net operating income. And that's where we see this right here. So that for these stacked triplexes in El Mirage, we're looking at $25.57 per month. Once we know our monthly NOI, just times that by 12, and we get the annual or yearly NOI, which is a little over $30,000 per year. So this is where we get the cap rate. Now that you know your NOI, you take your yearly NOI, you divide that by the purchase price over here, and that's going to give you your cap rate of 6.1% down here. So I hope that all makes sense. Remember, just to recap, you have your income, what you're going to be bringing in, collecting. You want to know what you're going to be making on that investment. Then it's important to understand and go through and figure out all your expenses. That's step number 2. And once you know those 2 things, then you can figure out what your NOI is going to be, your net operating income. Once you have your yearly NOI, divide that by the purchase price and you get your cap rate. So when you're looking at other investments and you're comparing apples to apples, remember those things. Something so simple, but very important if you want to truly understand and evaluate one investment versus another. So what is a good cap rate, you might ask? Well, it just depends on what the market's telling you. As we went through this, we figured out what our income was, the expenses, and we found a cap rate. You can do that with different investment properties that you're looking at within different states. Once you do that enough, you can figure out what that going cap rate is for that market. For example, for what we've seen for Arizona, Idaho, Utah, the average cap rate currently, right now, you're about a 5% cap rate, maybe a little bit lower. That's what we've seen for investment properties that are currently trading, that are finished and leased up. So when you're investing with FIG, there's a little bit of risk that you take on. You take on the risk of a construction loan, and then you're waiting for it to be built. Those are some of the downsides. The upside is the cap rate that we just talked about. We like to stay about a 1 to 2% cap rate higher than what that average or that market cap rate is, whether it's in Texas, Arizona, Utah, or Idaho. So on our pro forma here for El Mirage, you see a 6.1 cap. We know that the market cap rate for stuff that's finished in investment property is around a 4.5 to 5% cap rate. That's what makes this look so attractive to our investors.